Hey, this is Sasha, and thanks for joining me for another episode of Let's Talk Stocks. Today, what I'd like to do is just do a quick little vlog and give you some insights about trading losses, when to take profits, and market euphoria. When you're looking at overall the stock market, you're trading, if you're new to investing, and you constantly see a grind higher and things are always moving in your direction, and you feel good about yourself, it's usually that exact time when the rug gets ripped out from under you. And the same thing to the upside or the other direction is anytime you start feeling really bad about your positions or things just seem really horrible, it's when things actually start to go in your favor. The market likes to fool the most amount of people in the least amount of time. That's just what it does. So when you look at the overall market movement here today, actually, here's kind of some of the trading screens and things that I watch. So as you take a look here overall, this is the S&P. It was up much higher, actually about 30 points at the very peak. Right now we're up still about 21, 22 points, but you could see this little bit of a sell-off right here that's kind of coming up. But this is just the daily chart. That's just for today. Normally also what I have here on my screens is a couple of other stocks mostly that move the S&P 500 like Amazon, Apple. Also have Microsoft, P&G, might be like a Google and a JP Morgan. And I also take a look at the futures, the /ES and the VIX. So if you look at the VIX here today, you can see how we had that pretty big significant spike right up here. And that's actually at the exact same time when this market was moving up higher. So to me, when I saw this VIX spiking up to this upside, it actually had me a little bit of a concern. And you know what's interesting is as we're selling off, we actually have a lower VIX. So anyways, when you're paying attention to these little divergences and little movements, you know, they can definitely be surprising and you have to take notice. For example, if you look at some of the companies the other day, when we look at NVIDIA, how big or nasty of a sell-off you really had there. Certain moments like this can really take out, you know, a month's worth of gains. If you look at Facebook also, you know, boom, one big down day. Now the question is are we going to go up a little bit for like 3 or 4 days and then down further? And I'm talking about that for many companies like Google as well, even Apple, all these tech companies. Right now, what's actually moving the markets is with this tax reform mumbo jumbo is you have this things like the banks, like the JP Morgans. Like when you really look at this JP Morgan here, you look at this movement of how far extended we are, and you got these candles like going straight up, which is pretty remarkable. I mean, I got to give them credit for manipulating the market fairly well. In either case, you know, buyers are stepping in and you really can't deny that. So my point being here is that if you're looking to go into positions and you're just new to trading and you don't hedge your positions, trading with $1,000 or $2,000 of $5,000 or $10,000 with no hedges is perfectly fine, and it's okay because you probably don't have a ton of money on the line relative to maybe a little bit more. Once you start getting maybe $50,000, $100,000, there's things that you need to do to hedge, because what happens is that you get these nasty market pullbacks, and when you get a nasty market pullback, then it can really wipe out your account quite a bit. Now the downside with hedging is that when you get market movements like this, when you get these crazy movements to the upside, you know, when you get those kinds of movements, well, they can actually stop you out, and then within a few moments later, actually they go in your favor because they get so far stretched. And I will tell you that today, actually, I took quite a bit of losses because of that movement that we had here. So what is it that you do in these points and situations? How do you really know when things are going to work out, when things are not going to work out? When do you decide what to do or take your losses? Well, you know, the reality is if you're hedging, what I would much rather do is always take a little bit of a hit every single month on a hedge. And you're taking hits, meaning you're taking little losses, but at least you're protecting your bigger overall picture for the longs. And that is simply because when those nasty down days come, it can really stop you out and it can really create some trouble and problems for you. if you don't hedge, you can really get yourself in a lot of trouble. So I want you to be careful. If you do hedge, you're going to be taking a little bit of losses periodically, time and time again. And just like today for me, on those big up days, okay, like the days like today, you're going really high, you're moving to the upside, and it moves against your hedged positions. Well, you take those losses. So how do hedges really work? Well, the way that they work and function is that you're looking to put on some small positions either to the short side or selling call contracts or selling some kind of options or buying options to protect your longs. And that way, if the market does go against you or against the direction you're betting on, then what happens is at least you make it back on some of those hedges. Now, the inverse is true, really. Well, if it goes in your favor, but it moves too far too fast against your hedges, well, you lose money on those hedges. When you have a small account, it's usually not a big deal. When you have a large account, you definitely need to hedge. So basically what I'm saying is with a small account, most people don't bother hedging. But as your account grows and as you start trading larger, you'll probably want to hedge, because when you get those nasty pullbacks or nasty movements, they can really do some damage. So anyways, there's always going to be some debates that you'll have internally and mentally. Did I do this right? Should I have waited a little bit longer? And, you know, like for example, on this trade right now, I probably could have said, hey, I should have waited a little bit longer, an extra 15 minutes, 35 minutes. And my positions would have been fine. But in the marketplace, things can go much further, either to the upside or the downside, than you think or can expect. So what do? You take your loss. You take the loss where it's at, where you projected it when you were in a clear state of mind. Because if you're doing this and your mental clarity is off, game's over. You're going to take an even bigger loss. If you do this and you're not on your game, if you do this, you're trading emotionally, if you do this without a plan, if you get into a trade without, you know, setting up your trade or position, or at least a rough estimate of a plan, you're going to be in trouble. So my point here for you in this video is to really make a plan. Always have a trading plan for each trade that you take. Whether that's a rough idea, a guideline, a stop, whatever it is, create some sort of a plan. If you're not hedging yet and you're trading over $50,000, $70,000, you probably want to start hedging. Whether that's taking on some positions that are opposite to your normal positions. Doesn't mean you're going to be taking hits on them every single day, but in theory, you may be taking hits on them every month, but that's to protect you for when things go against you. You may think it's silly, you may think it's stupid, but when those days come, you're going to wish you had those hedges because you're like, oh, they saved me. So in either case, I hope you're having a great trading day. Even if you're taking a few losses, it's always a learning experience. Brush it off. Tomorrow's another day. You got this tax thing that's coming out. Probably will come out. It looks like they'll pass. So anybody making over $400,000 or $500,000 a year from their regular job should be doing quite well, and the corporations will be making more money. So that's a good thing for the corporations. As an individual person, based on what my accountant said and based on the consultations I had with some financial people, it doesn't look like it's going to be too good for the middle class or pretty much anybody making under $200,000 a year. So with that being said, I also want to let you know that I'll be doing a free webinar coming up next week, and we're actually going to be doing it with Ken Calhoun. So Ken Calhoun is with Trade Mastery over here, and he's been on things like the Money Show and so forth. And what I'm going to do is make sure I send out a newsletter with the registration details. As you guys know, I usually try to do a free webinar once a month, and this week we're actually going to do it with Ken Calhoun. So he's been in the trading business for probably 15 or 20 years, a lot longer than I have. Actually, when I started learning, he was the one who I took a look at, and some of his material is just he was already out there teaching people by the time I started trading. So anyways, thanks for joining me this week. So click some of the buttons here on screen if you want to continue watching the videos. Get on the newsletter list so you get notified on the webinars. hope you enjoyed this little live kind of vlog or a random kind of chat. And if you did, just let me know. If not, then, well, we don't have to keep doing them. I can do some other things in the future, just other specific lessons. But I just thought I'd share with you my thoughts, my ideas overall in the markets, and just some things about losses and hedging and just mentalities. So anyways, enjoy the day and make it a great one. See you next time.